You know, we're talking about the S&P having clicked to a record high, yet it's gotten there in somewhat interesting ways, right? You have a lot of these sort of defensive quality stocks, ones that do well with very low bond yields, holding up the market. A lot of other names, more cyclical, more perceived as more risky, have not really participated. How does this set up the market, do you think, going into the second half?
Well, I think that the fact of that leadership is an interesting aspect here. You know, we're at record highs or very close to record highs, but it's some of the most bearish or cautious attitude around that record high that I can remember. It's sort of a bearish market high, if you will, to your point, being led. Not only are there a lot to worry about, you know, everything from being in the longest expansion ever in U.S. history here in another few days to having an inverted yield curve and trade wars and geopolitical risk. A fresh 20% decline still in the memory of investors just late last year. So that's creating it. But just as you mentioned, the behaviors of everyone rushing to defensive stocks, to bonds, to gold, as anything but a bull sort of attitude. I like that. I like the fact of evidence of a wall of worry. And at the same time, policy officials from the Federal Reserve with faster money growth, to the Treasury with a large fiscal deficit to GDP ratio, to bond vigilantes, which have lowered long-term yields. And we're doing the same thing across the globe. A lot of support for this economy in this market and a lot of fear and caution. That's a powerful combination, I think, for higher levels yet, Mike, down the road.